Good Saturday morning to everybody, and welcome to Mortgage Matters radio show and the Connecticut Real Estate Edge podcast, along with Rob Weinberg. I'm Gary Byron. Of course, you can contact Rob very easily at 860-413-3938 and online at www.robgw.com. Well, good morning there, my friend.
Hey, Gary, good morning to you. How's it going?
Well, you know how it is. Well, it's mid-November. It's Saturday morning, and everybody's got, Thanksgiving, the holidays on their mind.
Oh, yeah.
I know. I meant to, by the way, you went on vacation. I know we didn't talk about this last week. We went right into the topic last week, but how was your vacay? I meant to ask you that.
Oh, yeah, it was great down in St. Lucia. I'll definitely be going back. Had a blast.
I heard great things about St. Lucia, yeah.
Yeah, I mean, hey, you got to have a way to, step back a little bit and enjoy.
Okay.
So that's what we did, took advantage of the beautiful weather down there and all the beaches and, water parks. And
Are
all
your
that
batteries recharged?
Oh, yeah, really, really recharge.
Good.
I don't know how anyone could do more than a week down at an all-inclusive resort. A week's good for me.
I'm guilty of this. So my last few days of work leading into a vacation, my mind is already in vacation mode. But having said that, my last maybe day or two on vacation, this is sad to admit, I'm actually heading back into the frame of mind of the amount of work that I've got waiting for me when I get back. It's.
Yeah, I think I've done quite a bit of traveling, over the years, a lot more before COVID, but I've been able to figure out a schedule while traveling to, take care of my clients and kind of the main things that need to be done while not putting a damper on the whole day or the whole vacation, right? So, for me, it's about keeping a good to-do list and then making sure that I'm prepared for when I get back. So I can step back. There were quite a few things that I said, I could do this today, but I don't need to do it today. I'm going to put that on the back burner till I get back, right? So then when I got back, I had a lot of clarity because I had a specific, these specific couple things that needed to get done, and I had them all done very quickly when I get back. But I think having that type of organization, at least for me, it helps me during those last couple days of vacation be present. Because I know, work is waiting, like you said, when you get back, but I know what the work's going to be, and I know I'm prepared for it. When I didn't used to do that, oh, gosh, I would have that anxiety those last couple of days, just trying to figure out what do I need to do and what am I walking into, right?
Yeah, all the time. Happens to me. This same thing happens to me. I went and looked at a few houses over the last, couple of weeks. I probably looked at 3 houses. And, The selection, first of all, there wasn't a high inventory even at the peak, time of year. But it's even less now as we head into, the holiday season. And the amount of people at one of these open houses that I attended was just incredible. In fact, I got there, 10 or 15 minutes before the start time, and there was already cars up the street, And I'm just finding, though, that the bidding war is just it's at an all new high. I mean, if you price it, if you're selling your house and you price it just right, you're going to get people into a bidding war. I think if you overprice it, you actually that'll work against you in the bidding war. But I wanted to ask you, and I know we've had this discussion in the past. The rates, everybody's talking about the interest rates, and I think you said last week that it peaked at an 8, and then it went right back down a few days later into the low 7s. But everybody, they kind of get a different rate. I mean, if someone's got a credit score of 610 and someone's got an a credit score of 810, they don't both get the same, interest rate, do they?
There's dozens of factors that go into the interest rate. The credit score is one of them, but it's just one. So, we've done whole shows about mortgage pricing and interest rates, but basically it's like the loan amount, the state the property's in, the type of property, what type of loan is it, mean in conventional versus like a government loan? What's the purpose of the loan? Is it a home purchase, or is it a refinance, or is it a home equity or second mortgage? What is the use of the property, like investment versus primary?
Like a conventional mortgage, yeah.
Yeah, so the thing is, when we talk rates on this show, we're usually just talking about the national average interest rates that are published on Google, and you can find on, Freddie Mac does a weekly survey of mortgage rates. So that generally is going to be like just a generic type of scenario, like, 720 credit score with 20% down, buying a single-family home. But most people do not fit in that box, right? So any given day, you might see interest rate swings that, could be anywhere from 1% to 2%, maybe even 3%, because non-qualified mortgages might be at 10 or 11% at some points, and a conforming or conventional mortgage might be at 7%. So you can't, you really can't look at that. One size does not fit all when it comes to mortgage rates at all. And I've had days where I'll lock one client in at 7%, and then I'm going and locking another client in at 9% on a different loan program in the same day. How can it be such a big difference? Because they're not the same deals. They're not the same clients, and all these factors are different. So, just know that, and don't take your interest rate advice from the internet. I guess that's the moral of the story there.
Well, they always have these mortgage calculators for online for free that calculate things for you. They give you a rough estimate as far as what your monthly payment would be. You're telling people to stay away from those things, huh?
Oh yeah, those I haven't really seen any scenario where those are accurate. There just isn't.
They underestimate or overestimate. Which is it, or both?
Most of the time, I find they way underestimate. The other thing that I find that kind of plays in with that is they'll put an interest rate on there that's a real interest rate, but if you read the fine print, the interest rate they're putting on those calculators, it might be like 1% below the market rate. Why and how are they able to do that is because they'll put in the fine print, this includes a 2-point buy down or 2.5-point buy down. Well, the average home buyer is not going to pay a 2 or 3-point buy down. Okay, so it's not realistic, but they do that to entice you, to make you think, oh, my payment could be that low. But again, so many factors play in, it's like 1 out of 100 that may actually be able to get any sort of payment close to what they're seeing online. So I always default to my home buyers, reach out to me if you're thinking about putting in an offer, and let's run numbers. Because another thing I've seen is sometimes they'll lowball the taxes or insurance, too, on those. So I saw one the other day, it had the property taxes is only $1,200 a year. The property taxes were over $4,000 a year. So whoever used that online calculator definitely made a big financial mistake. That's why you don't want to trust robots or computers to make huge financial decisions. That's for sure.
Yeah, I mean, that's a big difference, obviously. Hey, I wanted to talk to you. Maybe we can get into it this morning about escrow account services.
Oh yeah, well the escrow accounts are top of mind right now because a lot of homeowners have seen or gotten notices from their mortgage companies, their servicers that do these escrow accounts, and they've been told that they owe money. They've been told that their mortgage payment is going up because of the escrow accounts. So I've had probably a dozen conversations in the last month or so with clients of mine that were confused or just really uncertain about the escrow accounts, not necessarily what they were, but more why they were getting these notices and what they can do to stop it from happening in the future. So I wanted to do a refresher because we did a show on escrow accounts, over a year ago.
I remember,
a lot of good feedback. And now with the property taxes and insurance increasing in Connecticut as well as across the country, this is a huge a pain point for homeowners right now. And I also think it's important for home buyers to know about escrow accounts because they'll be able to avoid a rude awakening when they get their escrow analysis and have something like this happen.
So it plays a role, right? When I'm talking about a mortgage escrow account, what role does it serve a homeowner?
Yeah, so escrow account, like just the name escrow, like what does that mean, right? So in the context of a mortgage, the escrow account is going to collect money to pay your property taxes, your hazard insurance, and your flood insurance. And the money is going to be dispersed out from that account on a set schedule on your behalf. So that's what the escrow account is. As far as how it works, when your loan is originated at the closing, the mortgage company is going to collect a specific amount for property taxes, home insurance, and all that, so that it can be paid when those items are due. So what happens is they're going to collect this money from you. It's like funding a savings account. They're going to require that you put a certain amount in this savings account up front so that when money has to be paid out of that savings account, there'll be enough in there. And then every month when you pay your monthly mortgage payment, if your mortgage includes an escrow account in it, then they're going to set aside part of that money every month is going to go into this side account. Then they're going to periodically make payments as needed. So when your insurance comes due, they'll send a payment out for the insurance. When your property taxes come due, in most areas of Connecticut, it's twice a year. Some areas it's quarterly, but most areas is twice a year. In January and July, the mortgage company is then going to send out those payments on your behalf, so everything gets paid and, everything kind of works well. So that's really the gist of what the escrow account is and how it works.
What expenses are covered through an escrow account, and how is disbursement even managed?
Right. So the expenses that are covered through the escrow account are going to be property taxes, hazard insurance, and if required, flood insurance is also paid from the escrow account. Now, there's certain different escrow accounts that might allow you to have taxes included but not insurance. Other people may want to include insurance only but not taxes. But generally, majority of people include both the taxes and the home insurance, whether that be hazard and or flood insurance, in the escrow account. As far as the disbursement being managed, is the mortgage company is going to have an escrow department, and their job is to make these payments periodically as needed from the account. So they're going to have a schedule, and generally that schedule is going to be set up at the closing, and it's going to determine when is the next payment due for the property taxes, when is the next insurance payment going to be due, and when are all of the payments over the year going to be due, right? So is it paid quarterly? Is it paid semi-annually, annually, et cetera? So they're going to have all that documentation and set up done at the time that your mortgage is originated at the closing. And then on an ongoing basis, they're going to, manage that account and send those payments out. Sometimes they'll send payments electronically. Sometimes they'll send them by, paper check or by mail. But it makes it so that you as the actual homeowner, as the one paying the mortgage every month, you don't have to worry about writing a separate check to pay your property taxes or insurance. It's paid through the mortgage company.
So at what stage is an escrow account established? And actually, where is it detailed within the closing documentation?
Yeah. So the stage that it's going to be put in place is going to be at the closing. So it's not done beforehand, and it's generally not going to be done after the closing. It's going to be done at the closing. So when we lock your mortgage in, we're going to, as the mortgage originators, we're going to determine whether the mortgage includes escrow or not. And if it does include escrow, then they're going to go through this initial deposit at the closing, which is going to be included in your closing costs, so that you can have these items, again, prepaid into the escrow account so they can be paid as they're due. Now, as far as where it's detailed within the closing documentation is going to be on the settlement statement, or what's known in the industry as the closing disclosure, CD. It's going to be a document you'll sign at the closing that has the reconciliation of all the fees and charges that you're going to pay, as well as your monthly mortgage payment breakdown. And on the second page of that closing disclosure or settlement statement, generally there's going to be a section that's going to say prepaid items and, collection for your escrow account. And that's going to detail all of the payments that are being made into the escrow account at the closing. So if you're wondering if you have one or what or how it was set up, go look at those closing documents. Look for that closing disclosure.
No, I'm wondering where the funds come from to set up the escrow account.
Yep, so the funds for setting up the escrow account are prepaid items collected at the closing. So it's generic, we could just say it's lumped in as part of your closing costs. So we've done a lot of shows and educational pieces about closing costs and the different pieces. The escrow or the prepaid items are one piece of the closing costs that you're going to pay at the closing. So the money comes from, generally it's going to come from you. It's going to come from whoever is paying the closing costs at the closing. Of course, there's certain circumstances where you may have the seller paying some or all of your closing costs at the closing. And in that case, if you have the seller paying your closing costs and prepaid items, then the seller would be paying some or all of the, this escrow collection. But in most of these circumstances, especially in today's market where there's not as much seller concessions going on as there was previously, the buyer is the one that's going to be responsible for those escrow costs. And again, they're just going to be lumped in as part of your closing costs.
Are mortgage escrow accounts, are they mandatory for all types of loans, or is that up to the individual buyer?
So they're not mandatory for all types of loans. They are mandatory on FHA or most government-backed loans will require it. So if you're getting a government-backed loan, even if you're putting a large down payment, you are still generally going to be required to have an escrow account. Conventional loans do not require an escrow account as long as you're putting more than 20% down. So if you're putting more than 20% down, you'll have the option of including an escrow account or not. It's really personal preference. If you're someone that's good with money, you're good with saving, you don't mind paying those bills out of your own account, then not having an escrow account is a great way to go. If you're someone, though, that wants simplicity and you want to just make one payment every month and not have to worry about managing your taxes and insurance, well, in that case, then you'll want to have an escrow account. And I'll tell you that the majority of homeowners do choose to have an escrow account because, again, it's just easier, simplicity, consolidation of bills into one payment. It's attractive to a lot of people. So ask your loan officer about it if you are putting more than 20% down. And a little side note is if you get an escrow account at your closing on a conventional loan and then many years down the line or even a couple years you decide you don't want one anymore, I have heard of many mortgage servicers that will allow you to request their escrow to be removed off of your mortgage, and they will allow that to be done.
Folks, you are listening to Mortgage Matters radio show in the Connecticut Real Estate Edge podcast, along with Rob Weinberg. I'm Gary Byron. You can reach him very easily online at www.robgw.com. Of course, you can also call him to make an appointment. I know, that's old school. 860-413-3938. There's got to be, like anything else, Rob, some drawbacks or maybe even potential issues associated with maintaining an escrow account, like such as something called an escrow shortage. Want to explain what that would be? Or
Yeah. I mean, this is the big drawback of the escrow account. What's the catch on the escrow account besides having to put the money in up front? The other piece of the puzzle that people get a rude awakening on is what's called an escrow shortage, okay? The escrow shortage is when naturally your property taxes go up and or your home insurance goes up, and then the mortgage company has to raise your mortgage payment in order to accommodate that shortage. So a lot of the time the way it works is the mortgage company gets notified of an increase on your tax and insurance, and then they go to make that payment out of your escrow, and there's not enough money in the escrow account. So it's like there's a shortage in your account. So rather than not paying the bill, what happens is the mortgage company will go ahead, they will pay that bill on your behalf. They will advance the money for you, kind of like overdraft protection. So they will take the money out of their account and advance that on your behalf so the taxes or insurance will get paid, but then they will come back to you to get repaid. So generally that's when you get this notice in the mail saying your account's short and you owe a bunch of money. I've seen cases where it might be as little as $20 or $30. I've seen other cases where it can be, into the several hundred or even thousands of dollars in cases like new construction homes or when someone does, renovations or something to increase the value of the property. Those are the circumstances where you see major escrow shortages. I would tell you on average right now, across, both Connecticut and Massachusetts, I'm probably seeing, maybe about $1,000 a year average shortage, somewhere in that range. So, that can be a meaningful change to your mortgage payment, $80 to $100 a month. And then also, you're not only having to make up the shortage from last time, but you also have to increase the amount you're putting in towards the next payment. So do you see how that can be kind of a financial debacle, right?
How much should you put in to this escrow account?
Well, you don't have to worry about how much you have to put in because that is determined by the mortgage company at the time of, your mortgage being originated. So there's going to be a few people that are going to determine that, a few different sets of eyeballs that are going to double check that. But basically the gist of it is there's in these computer systems that are used by closing departments at mortgage companies will put in when your taxes are due, all the different installments, when your insurance is due, and then that software system will calculate how much needs to go into the escrow account to make sure that it's 100% accurate without any issue. So the problem isn't necessarily, Gary, how much is being put into the escrow account and when. It's more so the fact that the expenses increased, and there's no way to say, in 2 years your taxes are going to go up by $2,000, right? So because there's no way to do that, it ends up being these notices people get, this rude awakening on these escrow shortages. So, that's the bad part of having an escrow account, but if you know your tax and insurance is going up, then you have to be ready for it. Don't be one of these people that just takes the tax bill and insurance bill and just throws it in the trash or puts it in a pile of mail. You need to look at these things because you are going to get notified about this way ahead of time, and if you actually read through it and compare it, you'll be prepared versus waiting for the mortgage company to tell you owe all this money.
Can homeowners receive refunds or may even recoup any funds from an escrow account? And if so, how long would it take to receive them after paying, maybe after a payoff or a closing?
Oh, yeah. So the bright spot of mortgage escrow accounts and where people really smile when it comes to escrow is the refunds of escrow accounts. Now, we haven't really been hearing about them lately because not as many people have been refinancing, but I will tell you that you will get an escrow refund typically when refinancing or selling your home. Anytime a mortgage is paid off that had an escrow account, generally an escrow refund will be issued as long as there was money left over in that escrow. Now, there's different ways that they get you that money. Sometimes it can come as a credit on the payoff statement called a net escrow payoff, and in that case, the mortgage company will just say you owe us that much less money when you pay the mortgage off. They'll just deduct off the refund from the total you owe them. Most mortgage companies that don't do that, but some do. All the other ones will just issue you a check out. They'll send a check out generally within a couple weeks of paying off the mortgage. The timeline is going to be different for every mortgage servicer, but what I tell all my clients is, be ready to wait up to 30 days for that money to come back to you in the mail after your payoff or after your closing. If you don't have a check or some sort of notification about an escrow refund within 30 days of your closing, then reach out to your previous mortgage company and ask them about it. They should be able to tell you, if you were due a refund, how much it was and when it was sent out or kind of what happened. So that's how you should.
How often does that happen? And is it collecting interest while it's in the bank?
Yeah, so there is a legal amount of interest that has to be paid on these escrow accounts, but because the balances are, we're not talking about $100,000 in them, so the amount of interest that's paid on them is, pennies. Yeah. But yes, there definitely is interest that's required to be paid in I believe, all cases.
All right.
So as far as how often, it's annually. It's on your your 1 year anniversary of when you took that mortgage. That's when they're going to escrow analyze.
My final question, Rob, is how frequently are these escrow accounts reviewed or even analyzed? And can homeowners request an analysis if they choose to?
Yeah, so the anniversary date of your mortgage is generally when they're going to trigger an automatic analysis of the escrow account. So if you took your mortgage out, November of 2021, then November of every year is generally when they're going to do that analysis of the escrow account. They'll send you it in the mail and or put it online on the website, and you want to look at this closely. I have clients quite often call me when they get this, and we go through it together so they can understand what's going on and kind of the why behind it. The big piece that everyone needs to understand is that whether you have a mortgage escrow account or not, your property taxes and insurance are going to have to be paid. So it's not like you get out of paying this stuff if you don't have a mortgage, or there's a way to, reduce these expenses. The tax and insurance on a home is generally going to be the same whether you have a mortgage or not. It's just a matter of whether you're paying it or whether the mortgage company is paying it for you.
Wow, good to know. Do you recommend these? And you had said something earlier. I just wanted to clarify. If you put more than 20% down, you don't, at least from a legal perspective, you're not legally obligated to have an escrow account, right? So
it's not a legal obligation. No, it's more of a mortgage guideline. So if you are putting more than 20% down on a conventional mortgage, then mortgage lenders will not require you to have an escrow account. It's not a legal requirement. It's a mortgage guideline requirement. I will state that the guidelines for mortgage escrow accounts are different in the state of California. So California does have some legal things with escrow accounts that other states do not have, where I believe you only need to put 10% down in California in order to waive your escrow. In all other states, it's 20% down or more, again, generally on a conventional loan for that. So you have the option whether you want it or not. It's more of a personal preference. And I have that conversation with my clients, if there's an advantage or a convenience to having them escrow or not.
So it's something you recommend?
Some people I do recommend it, and some people I don't. I find that my self-employed clients, higher income, higher net worth type of clients that have a history of saving money, they are the ones that don't really need it. They're good enough at budgeting and saving on their own. There's an advantage to them paying those expenses on their own. The ones where I 100% recommend it pretty much without exception is first-time home buyers or younger home buyers that maybe aren't as experienced when it comes to juggling all the financial balls in the air when it comes to home ownership.
Well, that makes sense. Folks, you've been listening to Mortgage Matters radio show and the Connecticut Real Estate Edge podcast. If you'd like more information on this show or any of the others that we record, we produce for you every Saturday morning, simply head to Rob's website. It's www.robgw.com. By the way, if you'd like to email us on this show, you can get it aired as soon as next weekend's show. Or maybe you've got a question of a personal nature when it comes to your particular situation. Feel free to email Rob at mortgagemattersradioshow@gmail.com. And if you're like me, you're kind of old-fashioned, you like to do it the old-fashioned way, and you like to set up an appointment with Rob, this is how to do that. It'll expedite things a little bit. Give him a buzz, 860-413-3938. I'll repeat that for you. I'll slow it down. Write it down so you can call him now to make the appointment for next week. 860-413-3938. For Rob Weinberg, I'm Gary Byron. Thank you so much for listening to Mortgage Matters radio show and the Connecticut Real Estate Edge podcast. Until next Saturday morning, have a good one, everybody. So long.